All right, thank you all so much for being here and giving us this opportunity. We're so excited to be here and present all of our research. So today we are presenting a case study on the impact of the COVID-19 pandemic on community banks in the Shenandoah Valley. The goal of this presentation is to identify the most significant impacts of the COVID-19 pandemic on the banking sector and what lessons can be learned and implemented by financial regulators. So this is really a two-part question. First, we will discuss the impacts of the pandemic, and then we will talk about lessons to be learned.
These are the different ways in which we conducted research. To start, we read published research and media articles to get an overview of general impacts to investigate. We held conversations with 8 academics, 11 community bankers, and 3 regulators to choose which impacts we wanted to research further. We chose to focus on a geographical area as well as a specific banking sector. We were not aware of any specific research on the impacts of the pandemic on community banks in the Valley, so we felt that we could collect new data and provide some unique insights. We did this by creating and sending out a survey to community bank executives. We collected information on the impacts of the pandemic on their institutions. After our survey, we used primary empirical data to test our anecdotal evidence. Finally, to get a better idea of how widespread the trends that we saw in the Shenandoah Valley were, we compared Virginia data to US data and got feedback from a hedge fund manager who invests in community banks stocks, as well as some faculty. To start, let's define what is a community bank. We used FDIC data from their 2012 and 2020 community bank study to determine what to consider a community bank. A community bank is a financial institution that participates in traditional banking with specialized knowledge of their local communities. Community banks in the United States hold 12% of total bank assets, but are about 92% of all banks in the United States.
As you can see on the left, the United States has mostly community banks located on the eastern half. These are also located in primarily agricultural locations throughout this area. This contributed to us choosing the Shenandoah Valley as it is primarily agricultural as well as residing in this general area. So now that we know what our definition is and where these community banks are, Sarah Kate's going to talk a little bit more about our key findings.
From our analysis, we find that the largest impacts from the pandemic on community banks in the Shenandoah Valley were profitability, lending, and technology. I will give one impact and lesson for each of these. This is an outline of the rest of our presentation, so I will provide a summary, but further detail will follow. Profitability improved, but it must be monitored to ensure it's not a short-term boost. Lending strengthened and created relationships through the Paycheck Protection Program, or PPP, but risk should be monitored as deposits are promoting growth. For technology, consumer preferences have changed, which is increasing fintech partnerships. With increasing technology, there is increasing fraud, cybersecurity, and compliance risk. To start, shareholders are concerned with maximization of shareholder value. Therefore, we will analyze the profitability of Shenandoah Valley community banks to see how it was impacted during COVID-19. Looking at ROE, we can see that while it took a slight dip in 2019, it has since recovered and is higher than pre-pandemic averages in the Shenandoah Valley. Return on equity is driven by the two ratios, return on assets and equity multiplier. Incomes, expenses, and the provision of loan and lease losses drive ROA. Due to the near zero interest rates we were seeing during the pandemic, there has been some compression in net interest margin, or NIM. We see a large drop in the provision of loan and lease losses. Banks increased their provisions during the height of the pandemic. Now that the economy is improving, there are negative provisions which reduces the allowance to normal levels. This reduction improves overall profitability. Community banks should look out for the implementation of the Basel III Accord, which the International Finance Bank states could potentially cut bank profitability by up to 30%. This is extremely important as community banks will struggle to maintain high profitability as they transition from post-pandemic tailwinds and encounter headwinds from subdued loan growth and Basel III implementation. The COVID-19 pandemic also impacted lending. These financial trends are not only important for investors but regulators, as the trends could impact policy. The primary goal is to promote stability of the banking system to prevent negative externalities. Therefore, banks are heavily regulated to allow for financial stability through macro and microprudential supervision. On a bank's balance sheet, deposits are a liability. Deposits have grown during the pandemic, which leads to potential implications such as the loan-to-deposit ratio. We created these graphs with data derived from the UBPR to demonstrate these trends. Typically, the loan-to-deposit ratio is 80 to 90%. If it's too high, banks don't have significant reserves available for contingencies. But if it's too low, a bank is not earning as much as it could be. The OCC found 75% of bank exits in the bottom quartile of NIM performance were failures when limiting evaluation to recessionary periods. This could create a concern for the FDIC as they oversee the bank resolution process aimed at paying back depositors at a minimum cost to the Deposit Insurance Fund. This compression is also associated with strategic risks as banks must make efforts to elevate earnings, such as cost cutting. Given the background information we've seen, we wanted to learn more about how these trends were playing out for banks in the Valley. So on the next slide, you can see from data from the survey we conducted how we sought information on banks' investment strategy to see how banks were deploying their glut of deposits through the COVID-19 pandemic. Through that survey, we found that 57% had a shift to more illiquid assets in research and development, while 43% noted no material change in strategy. The St. Louis Fed states, as we saw during the last financial crisis, an increase in low-cost funding can incentivize some institutions to deploy their excess liquidity into riskier asset classes or loan types that are outside a bank's core area of expertise. To promote safety and soundness, it is advisable to avoid unnecessary risks rather than chase yield. When chasing yield, it is likely that credit quality will decrease, thus creating risk for the FDIC to maintain economic stability within the industry. Most importantly, institutions must keep risk management and matching of assets and liabilities at the forefront of all investment decisions. Now, I will pass it off to my teammate Nico to discuss PPP.
The COVID-19 pandemic had a reputational impact on community banks in the Valley through the deployment of PPP loans. To understand the impact, we need to go back to the Great Financial Crisis to see where the reputation of banks was then. During the crisis, the government felt they needed to prevent the entire financial system from collapsing. They passed legislation that was complex, misunderstood, and unpopular among the general public, despite being successful. The banking system as a whole was cast in a bad light. The COVID-19 pandemic response was different, both in speed and public perception. The government passed the CARES Act and made PPP loans available through the SBA. PPP was meant to help businesses meet payroll and pay other operating costs during government shutdowns. PPP money went directly to small businesses, so people felt that they were being helped directly by the government. We took data from the SBA to study how these PPP loans were rolled out in the Shenandoah Valley in Virginia, and then conducted interviews to see what effects these loans had on reputation. Community banks in Virginia played an outsized role in PPP loans. Despite holding 12% of all bank assets, they loaned 34% of PPP funds in Virginia, and 28% across the U.S. Their personal relationships with businesses were the key to this. Businesses and people saw how community banks helped their community in times of crisis. Community banks strengthened existing relationships, formed new relationships, and overall improved their reputation through helping businesses get PPP loans. This being said, the FDIC should monitor many of these community banks' new relationships, as some banks within the Valley gave loans to people across the United States due to new technologies and fintech partnerships, which is outside their area of expertise. This raises lending opportunities as well as operational risk. It is important to monitor. Next, my teammate Noah will discuss evolving technology in community banks and how it's been impacted by the COVID-19 pandemic.
As Nico was just discussing, there was a large impact from this technology onto these community banks. You can see how there's a larger jump in this and how branches were closing during this time period. You can already see this trend as branches were closing prior to the COVID-19 pandemic, but there's a large spike during the COVID-19 pandemic. This is in large part due to the lockdowns that the COVID-19 pandemic started to influence. On the left, you can see the new implementation and expansion of mobile banking and increased branch closures were the largest output of this new technology. If you look below this quote by the U.S. Bancorp CEO, you can see that the way that customers are interacting with banks is changing, and the pandemic has accelerated this behavioral change in a fairly substantial way. On the next slide, if you look on the left, you can see where the biggest spikes in technological change were for these banks in the U.S. This is also what we found with our own survey when we conducted from talking to all of these different community banks in the region, with every response indicating a technological change of some sort within their firm. 44% reporting a change in their electronic signature software, so this is stuff like DocuSign, and 55% reporting implementation or expansion of online banking features. Now, these community banks weren't able to do this on their own. They had to use partnerships to be able to have this technology within their firm. This is where fintech partnerships really started becoming prevalent during the COVID-19 pandemic. Prior to COVID-19, in 2019, you can see that the ratios of how community banks view their partnerships with these fintechs is 21 and 28%. This is a big jump to 2021, where we're seeing 48 to 41% of how they view the importance of these partnerships. It's these internal software companies, these internal software and technology that larger banks have the advantage over community banks because they can do all of this in-house rather than having to outsource and get the software done by a third party. This is where community banks really needed to have these partnerships during COVID-19 with these lockdowns, with less traffic and more branch closures. They had to have the outsourcing of technology in order to survive and keep up with these larger banks in this time period. These fintech partnerships had large impact on policy as well, and Amelia will talk a little bit more about that policy now.
As Noah mentioned, the digital banking space has grown with these fintech collaborations, and that leads to concerns over consumers' data security. The chart on the left shows the results of a survey conducted by Deloitte, asking consumers' preferences when it comes to banks sharing their data to offer them better products. As you can see, the results are pretty split in the younger demographic, but as the age group increases, data security becomes more of a concern. This needs to be a priority for community banks especially, because the majority of community banks' clients fall to the right side of the chart. Another consumer protection concern is online scamming. Consumers are easier targets for scams like phishing because the cyberspace is enlarged. It is the community bank's responsibility to have proper controls in place to prevent scams, like encryption and two-factor authentication. We already see some data security controls enforced with laws like the Gramm-Leach-Bliley Act, where part of this law actually requires financial institutions to use encryption and best practices when handling consumer data. However, coming out of the pandemic, the Federal Trade Commission is expanding the requirements to be more stringent and specific. Regulators and community banks must also be aware of the changing landscape when it comes to financial crimes. With the increase in mobile banking, it is easier to create a complicated money chain and commit crimes like money laundering. The Financial Crimes Enforcement Network, or FinCEN, is a bureau in the U.S. Treasury Department tasked with safeguarding the financial system from financial crimes. We've seen the FDIC and FinCEN make efforts to find digital identity proofing solutions, which is something that will be absolutely crucial moving forward as we adapt to the increases in technology. The Bank Secrecy Act also addresses financial crimes, and it includes the record-keeping rule and the travel rule, which requires banks to retain information on transactions of $3,000 or more. However, there is currently a proposal by FinCEN to lower this threshold from $3,000 to only $250 for transactions that begin or end in the United States. All banks are required to retain up to 19 data points on each transaction, and if the threshold is indeed lowered to $250, banks will have to invest way more resources just to comply. And we will see an increase in compliance risk, cost, and we may even see further consolidations. In conclusion, these are the most significant impacts and lessons from the pandemic for community banks in the Shenandoah Valley and regulators. Because of improved profitability, community banks must monitor operational risk. And because of strengthened and new client relationships, community banks must prioritize deploying assets within their community and deploying deposits safely. And finally, because of changing consumer preferences and fintech collaborations, community banks must accommodate these preferences while mitigating compliance and cybersecurity risk. Community banks must prioritize these points in order to remain in alignment with the FDIC's mission of maintaining stability and public confidence in the nation's financial system. Thank you so much for the opportunity to share our research, and we will now open it up to questions.
I just wondered, with your surveys, did you find out what those illiquid assets were in particular?
Unfortunately, they did not give further detail on what those illiquid assets were or the research and development. So I wish that is something that we could do in a follow-up survey at another point, because it would definitely be a very big point of interest.
And this is a kind of just an opinion. I just would love to find out your opinion on to this question. You talked about profitability, and all banks' profitability actually did increase because of the PPP program. Do you think the FDIC should exclude the PPP revenues just to determine, what's the true profitability of that bank?
That's a really good question. I think that you could do it both ways. I think that there would be benefits and costs, again, of both of those. The PPP did not have a super high interest income rate, so I don't know how much it would significantly impact if you took it out of it. But I do think that it definitely, the two main drivers from the OCC data were the PPP that were increasing the profitability as well as the negative provision. So I think that it could be interesting to do an analysis on that to see what the difference is and how much of an impact that had.
I can add on just a little bit to that, a little bit outside as well. So looking at the profitability of these banks, the PPP is kind of unique where it's a one-time loans. So the effect of it isn't necessarily the profitability specifically of those loans themselves, but perhaps the kind of business that these community banks are actually going to get. So what we saw was that some of these community banks were servicing new customers or able to target people that they already had in their sites, which is increasing their customer base as well. So that's another piece of it that it could be useful in looking at the profitability going forward as it depicts all of the new customers that are coming in to look forward.
So you made a very coherent argument against reducing the limitation to $250 and the concomitant burden that would create. And I'm assuming you're drawing a through line to safety and soundness from the perspective you indicated it could lead to consolidation, things like that. Now, of course, that's a FinCEN regulation, as you pointed out. So do you have any thoughts about what the role of FDIC, who's accountable for safety and soundness of the financial system, should be interfacing with FinCEN that's trying very hard to minimize the fraud that escalated so significantly during the pandemic? Any thoughts about that?
Yes, that's definitely something that we thought about. And, when I speak about lowering the threshold from 3,000 to 250 and the current proposal that the FinCEN published, um, and like Sarah Kate and Nico mentioned before, it's really another cost benefit analysis of, I understand the reasons why they proposed it. It's to, combat money laundering and other financial crimes, and it's great for banks to have that information. But the kind of downside for community banks is if they're able to have the infrastructure to, not only gather the information, but retain it for 5 years. It's a lot more transactions. So when it comes to kind of the intersection or the different viewpoints, I'll say, between the FDIC and FinCEN, it's really tricky. I think that the FDIC would have a stake in maybe, not lowering the threshold as much because it is a pretty dramatic decrease from 3,000 to 250. And maybe that would mitigate some of the compliance risk that community banks will face if the threshold is indeed lowered.
In addition, I think this also opens up the opportunity for additional fintech partnerships. I think if fintechs were able to solve this problem for community banks of how to collect additional information in a cheaper, better way that does not increase the cost for community banks, this would be a very successful partnership. Therefore, I do see this as an opportunity going forward as well.
And I can add just one more piece to that. And that kind of gets into where it's kind of complicated with the fintech partnerships because these fintechs holding all of that, suppose they hold all that data, which would be very useful for these community banks. It creates issues where the FDIC isn't necessarily in charge of these fintechs in the same way that they're in charge of these community banks. So it provides a really, really interesting situation where fintechs can offer these community banks storage of data or even just ease of services in this regard. However, it opens the door for the FDIC to start writing and are possibly looking into how they're going to regulate that partnership with these fintechs and with these community banks.
Thank you. You really mined that for a lot of important elements. Thank you.
And so to follow up on that, because that's where had my mind is thinking about the fintechs, right? And you talked rightfully about the partnerships and how that can be beneficial to these institutions, but you also had an increased demand for fintech products and fintech services throughout the pandemic. So did you get a sense from your research or survey data about how fintech or if fintech is viewed as a threat to these types of competitive threat and how the institutions, how the community banks might deal with that as we push towards a shift towards online lending from non-banks or cryptocurrencies or anything else? And what did you find from that kind of an angle?
Yeah, so we actually have some anecdotal evidence from communications with one bank in the Shenandoah Valley that they said that they did not view it as a threat. They viewed it as an opportunity. And their reasoning for that was because if they partner together, they could no longer be a threat. It could offer more. So if they partnered together, it would just allow them to both grow together. So they, in that particular instance, said that they were not viewing them as a threat, but an opportunity, and utilized them significantly during COVID to advance their mobile and online presence.
In addition, one of the most interesting things that we saw in our research was the growth of community banks for online communities rather than geographical communities. For example, we found, and I highly recommend you look them up, it's called Redneck Bank, which is a bank that is fully online and designated only to loaning to this online specific community. Therefore, I do think the community banking sector may change going forward, but I think the relationship approach is essential. And I think that although fintechs do offer technology, they will never be able to replace the relationship that you have. And we saw with BBP how important the relationships are. And you can say maybe young customers might not be going into banks as well, but in times of crisis, you need someone you can call. And this is something that's really important, something that this pandemic made relevant, like brought to relevance once again.
Yes, if you get a minute today, definitely look up the bank that Nico mentioned because it's funny, and their website is, it's really fun to browse through, but it really does show the niche of online communities that community banks are now able to serve.
If any of you guys want to look that up, it is redneck.bank. So that's the URL that you guys can go to. So it's a bank fully and wholly dedicated to serving, per their words, rednecks and the communities across the U.S. So,
as a follow-up to this great conversation, one of the things that I was thinking about is, you charted the increasing concern about sharing data with third parties that, had a direct correlation to age. To the points that you all just made, do you think that one of the potential implications of the pandemic could have changed the perspective of young people relative to their relationships with community banks? Do you think that the fact that there was a crisis actually might have had a meaningful follow-on effect for them?
Can I just repeat the question back to you? I just want to make sure I fully understand. So, those in a younger demographic, you're asking if the pandemic changed their relationship with community banking. I would say yes, because you can see on the chart, Nico, if you want to flip to it really quick, you can see on the chart that um, the younger demographic is a little bit more comfortable with their data being shared. But that, and in general, I would say more comfortable with the technology and the different, apps and different features that you can use. I know I'm never going into a bank to cash a check. It's always on my phone. But I think that all of the technological advances that's come out of the pandemic for community banks, that gives younger people more of a reason to, use community banks because they have those convenient features that I think younger people really value.
Okay, and that might be a good place to stop. And just to reiterate again, thank you again for presenting. Your submissions were fantastic, and so was the presentation. I think we really all enjoyed the conversation and dialogue. So I hope you have a great rest of the day, and we will see you at the end.
thank you guys.
Thank you all so much.
Thank you so much.
Thank
Have a
you,
great
everyone.
day.
Thank you.